Wir sprechen hier mit Didier van der Veire. Er ist Fondsmanager und Head of Core Equity Funds bei der belgischen Fondsgesellschaft Petercam. Mr. van der Veire, what does it mean if an investment company says we are defining active management by the active share?
Well, as Petercam as a house, we are a house of stock pickers, so we pay a lot of attention to the alpha that's being created by our stock picks. And so when we speak about active share, why it is important for us is if you want to outperform the index, you need to deviate from it to some extent. And active share is a measure that has been introduced in the late 2000s actually to measure the way how active you are in a portfolio in terms of stock picking. So it actually is a new concept that can show on a numerical basis how active you are in the stock picking in the fund. So for us that's important to be able to show that to clients, but also to be able to differentiate ourselves from other people that claim to be active but that are actually not deviating a lot from what is already in the index.
To get a bit more into detail, how do you measure active share? Can you give us an example?
Yeah, okay. So the definition for a long-only fund like us is actually you take the sum of all the deviations of the positions in your fund with the weight in the index, and you divide them by 2. Then you get the active share. So that would mean, for example, if you would replicate the index, that your active share would be 0. And if you would invest your whole portfolio in shares that are out of the benchmark, you would have an active share of 100%. Empirically, it has been shown that you need to have an active share that is high enough to be able to generate some kind of a sustainable alpha. And so for us, that is around 60-65%. So we, in the portfolios, would have active share above 60%, what we claim to be an active manager. If you have much lower than that, we think it's difficult to be calling yourself an active manager and to be able to generate enough alpha for your clients.
But what differentiates this approach from a simple perspective of the tracking error of a fund?
Yeah, the tracking error was a concept that was much more widely introduced in the industry before the paper of Kramers and Petercam came out, and so they actually started to define an active manager on 2 levels: tracking error and active share. And that's why they introduced the concept of active share. Actually, tracking error for a stock picking house like Petercam is not giving you exactly a good feel of how active we are as a manager, because your tracking error will actually measure how much style factors you implement in the portfolio, how much do you deviate on a sector level, on a style factor, if you take active factor bets, and it's not something we are willing to do for our clients. We try to have a diversified portfolio with limited biases in terms of style, sector bets and all the like, but we try to make the difference on a stock picking level. And so tracking error measures your factor bets you take, and it's not something we are willing to do. That can be very successful for other fund managers, but it is not the style of the house. We are a stock picker, so we try to have a limited tracking error so that you don't deviate too much from, in terms of performance, from what's happening in the rest of the market. That we try to add to that alpha being created by the active management of our stock picking positions.
What does that mean for the structure of the funds, and how do you implement such a strategy?
Yeah, so if you want to have a high active share, that obviously means you need to deviate from what's already in the benchmark. And the benchmark is to significant extent actually, if you would take the top 10 positions of the or the top 10% companies in the benchmark in terms of market capitalization, those would represent nearly half of the index weight. We don't think there is a lot of value to be created by investing in those companies, so we would rather focus on the mid-cap segment of the market. We think that is a much more interesting part of the universe. So we try to be very active in the mid-cap area, and we also when we invest in the portfolio, we never look at what's in the index. We only invest in companies because we think they will add value, they are a good investment opportunity, not because they have a significant weight in the index. So we try to be focused on what can actually beat the index, what is creating sustainable value for shareholders. And so the 60 to 80 names that will be in the portfolio are actually chosen based on their characteristics, not based on their weight in the index. So we only focus on the active position we take, so how much difference do we have in terms of the index, and not on the position as such. So we can have, we don't care about the biggest positions in the fund. If we are convinced that a name like SAP is a very good investment, we will try to have a very high active share and not a big position, because it's already a big weight in the index. If we take a smaller mid-cap, in the index it doesn't weight a lot, so if we take a position, it's an active position, and then for us it's important to see how that plays out.
What can you tell us about the performance results that you have been able to obtain by such a strategy compared to other funds in the same sector?
Well, if we take the example of the Euroland fund, we've over 1 year, 2 years, 3 years, 5 years, 10 years, we've been able to show that the fund is actually creating quite a lot of alpha. So we've outperformed the market on all those time horizons. And it's not only that we outperformed the market quite substantially, we also did that with much lower volatility than that in the index. And I think for investors it's quite a healthy proposition. So the limited tracking error and the high active share has been able to create a substantial amount of alpha with limited volatility.
Thank you, Didier van der Veire. Thank you very much.